Right. Well, Matt, it's been a dramatic start to the year for oil markets. It's hard to imagine it's only been 1 week, but that 5% fall in value we saw overnight is the sound of a collective sigh of relief that for the moment, at least, it appears this crisis may be under control. But, longer term, the events of this week have really demonstrated that the oil market is vulnerable to an increasingly risky environment in general, particularly in the Middle East. And our view at S&P Global Platts is that actually at around $70 a barrel, the levels we were testing this week on the upside, there's natural market resistance at those levels. It's difficult to see oil breaking much higher than that. And in fact, what we've learned this week with one of the most difficult crises you could imagine is that in fact, the resistance is there on the upside for sure. A couple of reasons why. Seasonally speaking, we're at a weak time of year for oil markets. A lot of refineries are going into maintenance. A lot of demand is a little bit down right now. At this time of year, typically speaking, the environment is going to be a softer one, and that's actually helping to offset any potential move to the upside from here.
So come the summer months then, is it more of the same, or do you expect to see that upside then tested?
We do expect to see the potential for markets to move higher to be really tested in Q2, because right now, Jan, Feb, March, we're going to see that softer environment. Come April, May, or June, as the market starts to prepare for the summertime driving season in the U.S., all the things oil markets are thinking about all the time, if these events were to happen again come Q2, we might be in a very different environment indeed. Having said that, there is a lot of macro environmental factors in the market that will keep the markets fairly balanced for now. For example, the rate of growth in demand is somewhat slower than it has been in the past few years. There's plenty of supply coming to the market from non-OPEC producers, and those macro factors, supply growing, demand growing more slowly than recently, that will keep the market typically balanced. But come the summertime, I'm not so sure we would see the markets be quite so calm as they have been this week.
Okay, Dan has a question for you in Dubai.
Hi, David. It's Dan here in Dubai. Really interesting past 24 hours in crude oil. A lot of whiplash happening here. Tell me, though, on the question of demand, how do you see the fundamentals shaping out in 2020? Obviously, there's a number of moving parts here on the oil patch, but do you think demand is going to be as constructive as what it was in 2019, or are we in for perhaps a bit of a worry on the demand side?
Yeah, our forecast at the moment for demand growth in 2020, so for this year, is that we're likely to see demand grow by more than 1 million barrels a day over the course of the year as a whole. And that would actually be a faster rate of growth for oil demand than we saw in 2019. It's being underpinned by a couple of key factors. Firstly, the global economic environment, as we heard from your previous speaker just a few minutes ago, is generally supportive. The global market looks pretty good economically at the moment. And we also have the fallout of something very big in oil, which is the rollout of new fuel standards in the shipping community, the so-called IMO effect, which is helping to push demand higher as well. So we do see demand growing faster this year than we saw demand growing last year, but the risk is definitely to the downside for the rate of growth in demand. If we start to see the global economy wobble, if we see stock markets under stress, if we see the trade talks between China and the U.S. turn negative again, all those things represent risk to the rate of growth in demand for sure.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.